What if I told you that 3 ETFs launched just this year could completely transform your retirement income? We're talking about yields up to 6.99%, nearly double what most retirees are getting from traditional bonds. Now I know what you're thinking. Higher yield usually means higher risk, right? Well, stick with me because what I'm about to show you changes everything about retirement investing in 2025. Here's the brutal reality facing retirees today. Every single day, 10,000 baby boomers hit retirement age. That's 3.6 million people every year suddenly needing their investments to pay them instead of grow for them. Meanwhile, traditional savings accounts are paying less than 1%. Inflation is eating away purchasing power, and Social Security only covers about 40% of pre-retirement income. The average retirement now lasts over 20 years, which means your money needs to work harder and longer than ever before. Your grandmother could buy a CD paying 5% and sleep well at night, but those days are gone. Target date funds were designed for people accumulating wealth, not generating income. Individual bonds require at least $100,000 to diversify properly, and most mutual funds charge high fees while keeping you in the dark about what they actually own. This is the retirement income crisis, and it's happening right now. But here's where it gets exciting. 2025 has brought us 3 revolutionary ETFs that solve these exact problems. I've spent weeks analyzing the data, verifying the numbers, and I'm going to break down exactly why these 3 funds could be the game changers that retirement investors have been waiting for. Today, I'm giving you a complete roadmap for building a modern retirement portfolio that actually pays you to own it. Let's dive in. First up is the Vanguard Government Securities Active ETF, ticker VGVT, and I'm calling this the Income Leader. This fund launched in July 2025, and it's already proving why government-backed income is making a comeback. Here are the numbers that should get your attention. VGVT is delivering a 4.13% SEC yield. That's more than 4 times what you'd get in a savings account. But here's the kicker. They're doing this with an expense ratio of just 0.1% for active management. Let me put that in perspective. Most actively managed bond funds charge 0.5% to 1% annually. VGVT is giving you professional active management for almost nothing. Now why does the government securities focus matter so much? Because 89% of this fund is invested in securities backed by the full faith and credit of the United States government. Your principal isn't just protected by diversification or credit analysis. It's protected by the same guarantee that backs every dollar bill in your wallet. The fund holds 212 different government securities, so you're not putting all your eggs in one basket, but every single egg is government guaranteed. This isn't just buy and hold investing either. The management team of John Madzier, Nathan Persons, and Brian Quigley have decades of experience actively optimizing yields within the government securities market. They're constantly finding the highest yielding government bonds while maintaining that safety net. Let's talk real-world impact. If you invest $100,000 in VGVT, you're looking at $4,130 in annual income with government backing. That's $344 flowing into your account every month. For retirees who remember when government bonds actually paid meaningful income, this is like stepping back into the good old days, except with modern portfolio management and daily liquidity. Now let's move to our foundation play, the Vanguard Total Treasury ETF, ticker VTG. If VGVT is your income engine, VTG is your rock-solid foundation, and it costs almost nothing to own. We're talking about a 0.03% expense ratio. Let me break that down for you. That's $3 per year for every $10,000 you invest. Most bond funds charge 10 to 20 times more than that. VTG tracks the entire treasury market through 278 different treasury securities, giving you exposure from short-term 1-year notes all the way out to 30-year bonds. Here's why the treasury focus is so powerful. These are the most liquid securities in the world. Over $500 billion in treasuries trade every single day. There's no credit risk because the U.S. government has never defaulted on its debt. You're getting complete yield curve exposure, which means as interest rates change, different parts of your treasury holdings will react differently, smoothing out your returns. And because this is a passive fund tracking the Bloomberg U.S. Treasury Total Return Index, you're getting pure market exposure without any management risk. The compounding effect of those low fees is staggering. Over a 20-year retirement, saving just 0.5% annually in fees translates to an extra $10,000 to $20,000 in your pocket on a $100,000 investment. VTG lets you keep more of what you earn, and in retirement, every dollar counts. Plus, with the Federal Reserve positioned to cut interest rates, Treasury prices could rise while you're collecting income, giving you potential for both yield and capital appreciation. Now here's where we get aggressive with income generation. The JP Morgan Flexible Income ETF, ticker JFLI. This fund is delivering a massive 6.99% SEC yield. And before you ask, yes, that number is real and it's verified. JFLI launched in February 2025, and it's taking a completely different approach to retirement income. Instead of just buying bonds, they're building a diversified income machine across multiple asset classes. Here's the breakdown that makes this so interesting. 54% of the fund is in U.S. equities, but these aren't growth stocks. They're dividend-paying companies and covered call strategies designed to generate income. 36% is in high-yield corporate bonds for steady cash flow. They've got money market holdings for stability and even some international exposure for global diversification. We're talking about 483 total holdings across multiple asset classes, all managed by a team with 78 combined years of investment experience. The top holding tells you everything about their strategy. 35% of the fund is in JP Morgan's own high-yield corporate bond ETF. They're not reinventing the wheel. They're using proven income-generating tools and combining them intelligently. You've also got positions in JP Morgan's equity premium income ETFs, which use covered call strategies to squeeze extra income out of stock holdings. There are even positions in individual stocks like Microsoft, Meta, and Alphabet, but these are likely being used for covered call income generation. Let's talk about what 6.99% means in real dollars. If you invest $100,000 in JFLI, you're looking at $6,990 in annual income. That's $582 flowing into your account every month. Yes, there's more risk than government bonds, but here's the strategic thinking. JFLI is using sophisticated strategies like covered calls and high-yield corporate bonds to generate income while maintaining some equity upside. It's like having your cake and eating it too. Even if you experience some principal volatility, you're collecting serious cash flow along the way. Now here's where the magic really happens. When you combine these three ETFs strategically, they work together like a retirement income symphony, each playing a different role but creating beautiful music together. Let me give you 3 different portfolio models depending on your risk tolerance and income needs. For the conservative retiree who prioritizes safety above all else, I'd suggest 40% in VTG for that ultra-safe Treasury foundation, 30% in VGVT for government-backed income enhancement, and 30% in JFLI for yield boost. This gives you a blended yield of around 5% with maximum safety. That's a 60-year-old who's worried about market crashes and just wants steady, reliable income. For the income-focused retiree who needs maximum cash flow, flip that allocation. Put 50% in JFLI for income maximization, 30% in VGVT for stable government backing, and 20% in VTG as your cost-efficient anchor. This portfolio targets a 5.8% blended yield and is perfect for someone who has other sources of stability and really needs their portfolio to pay them. For the balanced retiree who wants the best of both worlds, go with equal thirds, 33% in each fund. This gives you about 5.4% yield with balanced risk exposure. You're getting government safety, professional active management, and sophisticated income generation all in one portfolio. Why does this combination beat everything else out there? You're getting higher income than target date funds, lower costs than most mutual funds, more diversification than buying individual bonds, and professional management at retail prices. Most importantly, you're getting transparency. You can see exactly what you own every single day, unlike traditional mutual funds that only report holdings quarterly. Now let me tell you why 2025 is the perfect time for these ETFs. Three massive trends are converging right now to make this opportunity almost too good to pass up. First, the interest rate environment is setting up perfectly. The Federal Reserve is positioned to cut rates, which means bond prices should rise while you're locking in these attractive current yields. You're getting the best of both worlds, high income today and potential capital appreciation tomorrow. Second, we're seeing the demographic wave of the century. Those 10,000 baby boomers hitting retirement every day are creating massive demand for exactly these types of income-focused solutions. When demand for something increases dramatically, the companies providing those solutions tend to do very well. These funds are designed specifically for this moment in history. Third, the innovation timing is perfect. These funds incorporate all the lessons learned from the 2022 bond market volatility and the 2020 to 2021 low-rate environment. They're built for today's extended retirement periods where people need their money to last 20, 25, even 30 years. These aren't your grandfather's bond funds. They're modern solutions for modern retirement challenges. So how do you actually implement this strategy? Start with VTG as your foundation because it's the safest and cheapest. Build that position first and get comfortable with Treasury market exposure. Then add VGVT for that government-backed income boost, monitoring how the monthly payments work for your cash flow needs. Finally, gradually introduce JFLI based on your risk tolerance and income requirements. You can start small and build the position as you see how it performs and how comfortable you are with the volatility. Here are your key takeaways. VGVT gives you 4.13% yield with full government backing and active management for just 0.10% in fees. VTG provides complete Treasury market exposure for practically nothing at 0.03% expense ratio. JFLI delivers that impressive 6.99% yield through smart multi-asset diversification and professional management. Together, these three funds give you the tools to build a modern retirement portfolio that actually pays you to own it. The retirement income crisis is real, but so are the solutions. These three ETFs represent a fundamental shift in how retirement income investing works. You're no longer stuck choosing between safety and yield, between low costs and professional management, between transparency and sophistication. For the first time, you can have it all. If this helped you think differently about retirement investing, make sure to like and subscribe because I'm tracking these funds all year long and I'll keep you updated on exactly how they perform in different market conditions. Your future self will thank you for taking action today. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.